And so what happened was by December 2021, when the Federal Reserve realized that there was a lot of inflation because of COVID, post-COVID, which is really this whole system is called quantitative easing. What they did in March was called quantitative easing. To intentionally raise inflation, they would have to raise interest rates. That's what happened here. But of course, many people started to see recession and a lot of these things. But recession, the Federal Reserve knew this before time. But what happened is that a lot of unprofitable companies from COVID, because think about it, a lot of companies made money not because of their product value, but because everyone was going to these products because they were so easy to go to. Because no one can go to a physical store and start to shop, so that many people started to use hugely. The problem with this is that if a lot of unprofitable companies are coming out about, and what they do is that they use this cash to spend it on unproductive items without increasing their product value, by the time there's higher interest rates, they're likely going to be bankrupt. And that's what happened. That's what started the market to go down during this month, because there was a lot of unprofitable companies started to lose a lot of money. Companies that were already losing money started to lose a lot of money because the amount of borrowing that they could get, they won't be able to borrow because they're too costly. And if this borrowing, if this cash that they got was not in a completely productive to put it back to their products, that could be dangerous. So that's what led the spark of the drawdown. And of course, during this year, like, it's normal. I don't think the market would have not fallen down to this rate if it wasn't for what happened in this month with Ukraine. Right? No one expected to hear that Putin would invade Ukraine or Russia would invade Ukraine. And that's what led to this drawdown forward. But of course, what led it further was not just Ukraine, but because of inflation and because of the Federal Reserve seeing that they're going to have to raise more interest rates than they thought. Inflation was more of a problem than they thought. And so that scared people further, and that sold people. Why? Because people are very anxious now. Remember what I told you ever since 2014? People have been very anxious that similar events from before are happening when they're not. When they should understand that when something has happened before, people are unlikely to do it because they learned from it. No, that's what led to big selling. And of course, when the big selling, what happens? Algorithmic trading. All the sells have happened. So when a big sell has happened, it's unlikely to sell forward because there's not a worse event to happen. And talking about inflation too, inflation was becoming a bigger problem even when that inflation and that interest rate wasn't occurring yet. They were just saying that they would have to raise interest rates more in the future than they thought. And that scared people, even though they didn't raise it yet. You see the mentality there? And that's what led to the market to fall down, but not because of economically. Right now, inflation has slowed down a bit, but it's still a problem. And many people are seeing many signals of a recession. But because of the market bottomed, people are actually in denial that the market's going to go up, because they're saying, like, why is the market going up if there's going to be a recession for sure? Because the market is not the economy. The market anticipates already the economy. Why the hell would the market go down because you think it's going to go down? The market already, everyone knows it will, and everyone knew it will over here. But what's a worst event that's going to happen after a big inflation happens here when inflation is already slowing down? There's less of a reason for the market to come down even. Yes, there is. There's less of a reason. Because remember, for the market to come down more, there has to be a worse reason. But when that reason that was worst has eased down, what makes you think that it's going to come down from thinking that for the market to go down, it needs to be something worse? Do you see the mentality there? That's what's going on overall. Now, many of you might be saying, like, wow, okay, yeah, finally. I want to congratulate you guys. We're now in 2023. I don't know what will happen next month, next year. Anything can happen, guys. World War III can happen in 2 years or 3 years. I keep saying that. But I think by now, you guys have the chip that when the market drops like this, you want to have cash and buy. And what do you think is going to happen here? What do you think? It's going to go up. A lot of people are going to disagree with me because they're going to say, no, but what about the recession? What about this? What about that? But it's because what I said. There's an 80% chance that won't happen. There's a 20% chance of what you're saying to happen because there is an efficient amount of resources to drop the market to happen because the worst has already happened. And it's already been factored in of what I just said. When you look at something, what makes you think that you're the only one seeing that? Everyone else has saw it. And so right now, people are worried about a recession. And all I have to say about that is what I just said before. We have these probabilities. It's up to you what you want to do. I can't control what you want to do. If you want to sell, do it. This is a free country. I don't know what country you live in, but at least you can do whatever you want, right? I can't stop you. But what I can tell you for sure is that every time the market comes down, especially now, the faster it comes down, the more likely it's going to go up. So if the market has come down immensely, and if there's less of a reason, less, right? What's a worse reason over here than Ukraine war, inflation, and interest rates, and the Federal Reserve raising more interest rates? What can something happen right now that's worse than that? Nothing. None of that has happened yet, and I don't think it will happen. Right. So that's the idea you have to keep in mind. It's up to you what you want to do. Right. And I'm going to leave it at that. I think it's been very educational to do this with you guys. You guys are seeing this all from the top view. You're not just seeing it in your perspective. You're now seeing it from a bigger, broad view. And you're seeing that really what matters is to hold, really, to just buy the S&P 500 and to not listen to any macro events. That's really the key. Right. But I can't change what you do. Or you just listen to what I say, and I don't know what you're gonna do. But that's the best solution in my view. I made in Google Sheets all the things that's happened, so we can kind of refresh all a lot of the things. I won't make this as long. It's probably gonna take 15 minutes for me to explain a lot of this. But let's go back to 1928, 1938. Remember the Great Depression? The market went down, bank runs, but what happened? When the worst happened, the market went up. But after this crisis, a great thing happened. The SEC was created, Social Security was created, and the FDIC was created. Then by 1936, there was a sterilization of gold because every bank was fearful in that they were so conservative that they were putting a lot in gold that was too unproductive to a case where stop trading with that gold, and that made the market come down. Then you had a very great output of 49% in the 1938. Then by 1939 to 1949, Hitler invaded Poland. Right? Hitler invaded 4 lower countries. A year later, the Pearl Harbor happened, but the market bottomed in the worst case after World War II, and it went up ever since and never touched. This is the S&P 500, by the way. The market has never touched. Look, the S&P was at $9. Right now, it's at 4,000, and this was the last time the market was at that time. So that's why I'm trying to tell you that when a bad thing happens, you have to understand that it's a worse thing is harder to happen. And the price that you're seeing right now is very unlikely it's ever going to be seen ever again. So do you really want to be the person in the future who says, I wish I really saw the market when it was at, I don't know, $1,000. Now it's at 4,000, right? And you regret that you didn't pay it at 1,000. It's the same case here. I'm pretty sure, like, my God, that'd be terrible. But that's happened a lot. Many people who saw the market at $9 did not expect, and they saw it still so dangerous, but they never expected the market nowadays, or even 30 years later, that it would be at $300 to $400. That's why you have to stay independent from what others think. But despite that, worst happened. Germany took over almost Europe, and it went up by 9 to 10. Britain liberated. Everything was doing well. And then the US bombed Japan. Germany surrendered. But even in that year, look at that. Even in that year, the market went down. Even in good news. You see? Because there was fear of the deficit with the US. But people didn't realize that in this year, or this one, Bretton Woods was created, and that would create a huge economic expansion decades later. And so by this year, this is where World War II veterans came back, or the soldiers came back. Then you had the Fed high rate recession. Oh, okay, so this is a summary from 28 and 50. Look at this. High rate recession, and the market went up. Look at this. The economy was in a recession, and the market went up. See, you shouldn't invest by economic factors. Well, look at this. The price was at $7, and it never went to $7 ever again in the future. Then in 1950, the baby boom. North Korea attacked South Korea. Despite that, the market went up. Then in baby boom, the market was at 26 and it went up a lot. Then by 1956, there was a Suez Canal. The market went down temporarily and it bottomed at 41. And I don't think it went to 41 ever since. And then by Kennedy, you see, even in that mentality, when people thought like, oh my God, the market was at $9, now it's at $40. That's so high. It's not high. The market right now is at $4,000, but it's not high because the economy, the companies will make more and more and more money as time goes on because we don't have unproductive values, unproductive consumers. We're not spending more. We want people who want better lives. That's why I love this country. What helps a lot is, I'm going to be honest. What helps a lot in this economy is the capitalism. A lot of people hate capitalism, but that's because they don't understand it. They think it's unproductive. But you have to understand that nothing's perfect. A lot of things are unproductive, right? Socialism isn't perfect. Communism isn't perfect. Capitalism isn't perfect. Nothing's perfect, but it's your decision where you want to go, really. For me, I'd rather stay in here because I believe I believe in a democracy, obviously. I believe everyone should have the freedom, what they want to be. And everyone should have the opportunity. That was the main reason why my parents came here, because they had the opportunity to have a better life than what they had over there because of the system. You have to be, anyone that lives, I am grateful. But if you were born in the US, you do not understand the privilege you have compared to other countries, and you really need to cherish that and make the use of all of it. But that's never going to happen. You see, it's not a perfect system. But at any rate, the 65 Vietnam War started, the market went down, and by 66 it was at 83, it went up and it went down, and now we're entering the stagflation. So by stagflation, high inflation started by 69, starting at $95, where I'm pretty sure people were thinking it was high. But out of all this, let's see, 50 to 71, the market had a full bull run. Anyone thought that the market was high in Kennedy slide, which it was, not even imagine that from 61 to 65, the market would be about at $95 or 95 points. And 3 years later, it would be at $100. It depends what side you want to be. I can't control you. And then look at this. From 28, the market, like, who cares what happens in the short term? Who cares if there's a Great Depression? Who cares if there's another World War? Who cares? Why? Because this doesn't affect consumption in the long term, right? And if it comes to that point, what makes you afraid about a recession that will happen? What makes you afraid whether the US has a debt or all this? This has happened multiple times, but no one understands this. We've had a Great Depression, for crying out loud. And even until that time, the market went up. Of course, the economy was different. It was increasing. You have to understand that consumption will not stop because of products that we're selling, because of the environment that we have in this country. People want a better life. By that nature, they're going to be consuming. People are selling productive items. They're not selling unproductive. We're not stealing from people. Then by 71, of course, you had the stagnation, which was stagflation. Bretton Woods ended. I'm pretty sure no one would have imagined in this time, in stagflation, that the market would be up as it is now. Coupor oil prices went down. Gold inflation from Disselink went down, went up. Extreme inflation, worst inflation. Volcker shock in 80 at 142. You see, even in the worst inflation, no one would have expected over here that the market would be up in 6 years later to 142. And then over here, no one even expected in 73 during the Coupor crisis that the market would have a full bull run, hitting new highs at 300 to 500. Despite the new wars, high budget deficits reduced the Louvre Accord, remember, that put the nail on the Japanese coffin on 1987, this bull run on the real estate market. Then Iraq invaded Kuwait. That was a spark of an oil crisis where the market went down. Remember what happens? Go down 342 and went up. No one expected it to 430. And then look at this. From 28 to 1991, a person who bought at the Suez Canal in 1956 would have made a ton of money until even in the high US budget deficits at 250. They bought at 48 and they now have at 250. That's about a 500% return. Now, of course, that's in 30 years or so, but you have to understand that there was stagflation for 10 years. Think about it. If the person thought like, man, I think the law of time, what if I sell in here? They would have made the worst mistake, because about 5 years later, the market would be at 430. They would have made 1,000% if they just waited 4 years later. And that's the same mentality I always try to give myself when I look at the market now. I have to understand that I can't predict everything. I can't know everything. I have to understand that based on history, even 4 years later, the market can go up really to that, from 500%. So you always want to buy when it's low, because it doesn't matter how low it gets, because it always will go up higher if there's productive things being sold. And what I always have said, 91 to 2000, the market had a huge bull run, but not a solid one. It was just because of computers. Even though computers were productive, but many people were becoming too optimistic on them. Subprime mortgages began on 92. The bond massacre happened here, and it looks like a shallow thing for the past 10 years. Hedge fund bailed out. Market didn't even care. It kept going up. Russia had a collapse during these years. The market kept going up. Housing bubble start. The market kept going up. Dot-com crashed. The market went down. 9/11 happened, and the war on terror happened. Then in 2001, the market bottomed at 895. You see, what was it at in 91? It was at 500. Who cares? And even if you invested here, it doesn't matter if the market went to 895. You just buy again, and you're not making a gain, but you will in the future. And that happened. Look, the market went up, but then the housing bubble burst in 2006, and that affected every bank that was involved in this schemish loan, like Lehman and Washington Mutual Bank, and that affected the markets temporarily for a year and a half. Then the market bottomed at 932. When there was a recession, the market bottomed and went up. And by 91, look at the summary, right? You would have seen like, okay, if I invested here during the housing bubble in 98, which really invested in the dot-com bubble, you would have broken even 12 years later, right? But that could happen. Now, that could happen if you invest in the bubble, like in all this stuff, right? But I never invest because there isn't or is a bubble. I never invest in companies if they don't have something productive that they're selling. That's just the simple case of it. You will never find me that I will invest in something that's in a bubble, or at least a company that's a primary mover in the bubble, because that's just not the way how I invest. I invest in solid companies that are making reputable and relevant and reliable sales, rather than people thinking it's going to change in the world. Of course, it helps a lot when it's a productive company and people think it's going to change in the world, because that does help, because it makes my investment go up more irrationally overvalued. Right? And then 2011, when the economy slowed and people saw the U.S. the debt ceiling crisis. Look at this. The debt ceiling crisis looked like nothing. It was barely a shallow retracement. The market went up, the slowest economic growth in decades. Still, the market went up, and then U.S.-China trade war, it went down a little, but it kept going up higher. No one expected. COVID, look at COVID. It looks like nothing. in the long term, because these are by years and years. This is the close of 2019, close of 2020. Why? Because 2020 closed positive. That's why there isn't any retracement here. Then we're now at where we are. This is 2022. The market went down at post-COVID result deflation, which is now going down. And now the market's gone down and it's gone up in total. So let me tell you, look at all the reasons to sell for the market, every single reason. Despite that, the market has gone up about 99% of the time. Let me tell you this. Are you going to buy in this retracement or are you going to sell? That's completely up to you. But my job is to just show you this, and it's up to you to do what you want to do with it. All right. I'm going to leave it at that. It was a great pleasure sharing this with you guys. You've learned a lot from this, I'm pretty sure. And yeah, I'll see you guys in the next lesson. All right.